Hello, everyone. Today we want to take a look at underemployment. So underemployment combines three things together. The first is something you're probably very familiar with. It's the employment report that we see the first Friday of every month, and that unemployment rate, the U3 rate, if you know the technical side, is the base for this. We then add two things to get to the rate you'll see on your screen in a minute. The first are marginally attached workers. So these are workers that have looked for full-time employment, have done so in the last 12 months, haven't been able to find a job and are maybe slowing their search just because they're a little bit discouraged, but they're still attached and still want full-time employment. The last group are those that, again, want full-time employment, but again, haven't been able to find it, so they've taken a part-time job in the interim. So this is not the level of employment that they want, but they're doing this while they're still looking for that full-time role. So if we add those three things together, you see what you see now on your screen. Latest reading, 8.1%. You see off a base of the most recent low of 6.6 in November of 2022. So you see the shaded bars there are our most recent recessions, and the series goes back to the mid-90s. A couple of notes. I mean, our absolute level of 8.1 is not high necessarily relative to history. You see plenty of periods of time and numbers higher than that outside of those shaded boxes when the economy was doing just fine. So it's not the absolute level that necessarily has our eye, it's that trend. It's the grind higher that we've seen in many of these employment and unemployment measures that typically historically has been consistent with either heading into or already in a recession. So, this time is different, the most dangerous words in finance. The pattern here definitely is different. The speed of us getting to an economic slowdown is longer than it has been historically when we've seen this type of move. And if you look at current data, it doesn't look like that slowdown is immediately around the corner either. So we'll certainly keep an eye on this. One other thing that's going to just make this even more complicated is the very high likelihood of a government shutdown this week. This report is supposed to come out on Friday. If that shutdown happens, it's highly likely that it will be delayed. It also delays the data collection in that period. So when we finally get this report, it very well could be late, it could be incomplete or partially complete relative to what we're used to. So just be aware of that as we see these numbers come out. And the last note is that this just further complicates the really hard job that the Fed has already. So they're already balancing economic growth with employment, with inflation, and now they're highly likely to have to do so with incomplete or delayed data. So interesting time to be a Fed governor for sure. We'll certainly keep an eye on this underemployment rate, and we'll let you know when we have more thoughts on it.